Hello traders, how are you doing today? Today I want to introduce you to the concept of fair value gaps and imbalances. It's going to be a very exciting journey, and I want you to be focused, get your writing materials, and take notes, because this is a very valuable and important concept. The concept of fair value gaps and imbalances will revolutionize your trading journey. Now, in trading, a fair value gap simply means a price imbalance created when the market moves aggressively in one direction. So when there's an aggressive move, when institutions enter into the market aggressively, when there are the big banks enter into the market aggressively, or smart money enter into the market aggressively, we usually see a imbalance in price, a huge pump aggressively. So you can see a single candle move a bit unusual, unusually long, either a bearish candle or a bullish candle. Now, as we continue, I will explain this more. Now, whenever this huge move takes place, in the market, it usually leaves an area behind where there is little trading activity. Now, an FVG usually forms with a 3-candle pattern. When we talk about FVG, it must have that 3-candle pattern. I think that's what this differentiate between an FVG and an imbalance. Now, before I continue, most of you hearing me, you must have heard the word FVG and imbalance used interchangeably, and those that have used it interchangeably have used it with the best of intentions. Now, an FVG is a type of imbalance. So I want to put it this way: all fair value gaps are imbalance in price, but not all imbalance in price are fair value gaps. I want to say that again. All fair value gaps are imbalance in price, but not all imbalance in price are fair value gaps. So when we're talking about fair value gap, we are talking about strictly the 3-candle formation. Now, if you look at this example here, you can see the 3-candle formation: candle 1, candle 2, and candle 3. In the case of a bearish FVG. Now, in the case of a bullish FVG, like you can see here, you can see candle 1, candle 2, candle 3. Now you can see a huge move to the downside. You can see this candle 2. So your candle 2 is usually the huge displacement candle. You see that's the fair that's the where aggressive buyers or sellers entered into the market and pushed the market in a particular direction aggressively. So at this point now, we see the origin candle, or we can call it the pivot candle, and then you see that at this point sellers entered into this market aggressively and caused a huge dump to the downside. So you can see a huge dump to the downside, and then you see a continuation in price at this point, candle 3. Now, the gap between candle 1 and candle 3 is what we call our fair value gap. Just like you can see the gap between candle 1 and candle 3. So the close of candle 1 and then the opening of candle 3, the gap between the close of candle 1 and the opening of candle 3 gives us the fair value gap. Now you can see that example also in the bullish scenario. Let's look at the bullish fair value gap. Let me zoom in. So in our bullish fair value gap, you see your candle 1, the pivot candle, and then you see your candle 2, where we see the huge pump to the upside, and then you see your candle 3, and then you mark the closing of candle 1 and then the opening of candle 3. You see between that gap, you see there was no trading activity within that gap. That is what we call our FVG, or our fair value gap. Now, how do you trade fair value gap? Now, most traders, I'm going to give you a mechanical approach for trading fair value gap. Now, most traders, when trading fair value gaps, wait for price to retrace into the fair value gap. So after candle 1, candle 2 has formed, and then candle 3 has formed, giving that fair value gap, that FVG candle 1, candle 2, candle 3, or FVG 3 candle formation, they wait for price to move back into the fair value gap, at least 50% of that fair value gap. You will usually, or they will usually use the Fibonacci retracement tool on TradingView to mark out the midpoint of that fair value gap, wait for price to come in within 50%, which is the midpoint of the fair value gap, and then wait to see a change of character. So a change of character to the opposite side, and then which is a major confirmation, and then they enter the trade, putting their stop loss on top of candle 1, which is at this point on top of candle 1, and then put their TP below candle 3. So these are a clear example. So what do you see here? We see, let me do something like this quickly. So we see a fair value gap formed, and then using your Fibonacci retracement tool, we mark out 50%, the 50% level. This my marking might not be correct, but let me let's take this as 50%. Let's take this as 50%. So let me move this a bit. All right, so using our Fibonacci retracement tool, we mark out 50% level, and then what do? Wait for price to retrace back into this fair value gap. So we can see something like this. Oh boy. Okay, so we see price begin to retrace. You see that price retraces into the fair value gap, at least 50% level, experiences a change of character. So if we see something like this take place, let me delete this. If we see something like this take place, we're not going to enter. We see something like this take place. So instead of the bullish candles to reduce in momentum, we see them still moving aggressively towards the upside. You see now. So this does not give us the confirmation we need. So we will not enter this trade. While sometimes it will go beyond this 50% level and then go straight to this origin. Go into the origin, which is your candle 1, and then before you begin to see a dump to the downside. You see a dump to the downside. So, but basically, for the sake of this class, we're going to be working with that 50% level. So let me remove all of this. All right, so that's it. So we wait for price to retrace into the 50% of our FVG, and then wait for a change of character, and then we set our stop loss, set our take profit, and then we enter the trade. Now I'm going to open the chart. I'm going to open TradingView and show us an example of a fair value gap. I'm going to show you an example of a bullish fair value gap, and if we see a bearish fair value gap, I'll also use that also as an illustration, and then that will be all for our fair value gap class. And then I'll record another video explaining imbalance, and then we'll move on to liquidity and liquidity zones, and then we'll move on to key levels. So if you have not subscribed, kindly hit the subscribe button, like and subscribe, click the notification bell to get notified when we post new videos. So I'm going to open a TradingView right now. I'm going to open TradingView. All right, so this is TradingView. Now on this chart, we are going to see the 3 candle formation which we spoke about. 3 candle formation which we spoke about. Now if you look at this, we are going to see that we see a candle form here which forms our origin, candle 1, and then we see at this point a huge push to the upside. You can see that, a huge push to the upside, forming our candle 2. Now permit me, I think let's do this on the 1 hour time frame. Let's do this on the 1 hour time frame. the 1 hour. Okay, the 1 hour time frame. We can do this on the 15 minutes also, but let's just use a higher time frame. Okay, so we see the movement here. We see candle 1, we see candle 2, and then we see candle 3. Let me zoom it out so that you can see it clearly. So see a 3 candle formation here, 1, 2, and then 3. Now we can see our gap, the gap between candle 1, the gap between candle 1, so see that, candle 1 and candle 3. This is candle 3. All right, so we can see a clear gap between candle 1 and candle 3. This is our origin or our pivot candle. Let me mark it out using my rectangle tool. This is our origin or our pivot candle. You can see the gap between this and this. And then we're going to use our Fibonacci retracement tool. If you look at this, if you are new to trading view, number 1, 2, trend line 2, and then you see this tool here, Gann and Fibonacci tools. You click on this arrow, and then you see all of these tools. You click on the first one, Fibonacci or Fib retracement, or use this shortcut alternate F. So I click on my Fibonacci retracement tool. I click on the beginning of the gap here, that is under candle 3. I click on it and I drag it to, I move my mouse to this point where the gap began. So you see that? Let me zoom it out so that you can see what we just did. All right, so you see that from this point to this point. Now if you look at it carefully, you can see the midpoint. Look at it, 0.5. So we see 1, 0, 0.5. So this 0.5 level is the midpoint, or what we call 50% of our fair value gap. So what do these traders do? They wait for price to retrace back into at least 50% of this gap, see a clear change of character to the upside, that's in a bullish FVG scenario, and then they take their entry from that point. So now in this case, we're going to see that price pushed up to this point, pushed up to this point, it pushed up to this point, retraced a bit, pushed up to this point again, and then we began to see a dump to the downside, a dump to the downside, a dump to the downside, and then price came within 50%. Look at let me mark our 50% level. I'm going to mark our 50% level. Let me use this horizontal line tool. So you see that now, price came within 50% of our fair value gap. And then we waited for a confirmation. And we saw a confirmation here. Price came, you see that, after coming to our 50% level, price moved to the upside, reacted at this 50% level, pushed the price to the upside. You see that now? Pushed the price to the upside, giving what? A change of character. Now if you look at it now, push price to the upside, came down, did not clear this previous low. You see that now? It did not come to clear this previous low. Instead, it created what we call a higher high at this point, and then push price to the upside. Now this point here, this is our clear change of character. This is our change of character. All right, this is our clear change of character. Change of character. So you see that? We see a change of character here, and then price pushes to the upside. Now there are two ways of entering this. We have the aggressive method, and we have the conservative. Now the aggressive method will do you a lot of damage when you are trading FVG. Now the aggressive method is that when the price, immediately the price comes to your 50% level, you take the trade, set your stop loss under this point, and then you move. But you may see price dump and even come to your stop loss in some cases. So to be on the safe side, we'll take the conservative approach. The conservative approach is to wait to get a change of character before taking our trade. Now, those that take their trade with the aggressive method, if you take your trade with the aggressive method, so we are opening a long position around this 50% level, and then we are putting our stop loss under this candle. You are going to see that we have a very huge stop loss, and then we are targeting this last high. You see that now? We're targeting this last high, and you can see our price went straight to take profit. You see, but this is a 1 hour time frame, and you are seeing the huge stop loss. Not everybody can have the account to take this kind of risk, but it's a good risk to reward anyways. But then let's try a more conservative approach. Now, in a more conservative approach is to wait for a change of character and then wait for price to retrace before we enter the trade. So in that case, when price retraces like this same principle applies both in a bullish scenario and in a bearish scenario. When price retraces after a change of character, forming a higher high, now we're expecting price to, price has broken above this, giving us a change of character to the upside, and then they wait for a retracement before entering. So that the conservative traders can decide after this retracement to take their trade from this point. So you can decide to take your trade from this point. You can decide to take your trade after the change of character. So they can decide to enter from this point. They put their stop loss under that 50% level and then target this high. So in this case, we have a smaller stop loss. But you see, this buy was so interesting. This buy continued up to this point before price began to retrace. So this is it. This is an example of what we are talking about when we are talking about fair value gaps and how to trade. In this case, you will notice that price did not retrace back to this origin. Price only came to 50% of the fair value gap, created a change of character, and price pushed to the upside. So this is a clear example of a bullish change, of a bullish FVG. If you have a question, you can drop it in the comment section. Now let's see if we're going to see a bearish example on the chart very quickly. A bearish example on the chart. A bearish example on the chart very quickly. Now, one of the trading tips I'm going to give you, this is a pro trading tip. When price is bullish, it is safer to trade bullish fair value gaps. When price is bearish, it is safer to trade bearish fair value gap. At this point, you see price was bearish, the order flow, and then at this point we see a change in the order flow of the market, and market became bullish, where it created this bullish FVG. So you see, we are trading this because order flow has changed to bullish, and then we are now seeing a bullish FVG. All right, so let's look for another example. Okay, I think this is another clear example. It's another clear example. From this point now, we are seeing the order flow as what? Bearish. And then all of a sudden, in this bearish order flow from this point, because the market is in a correction phase, the market was in an impulsive phase, and then the market entered into a correction phase. So in this correction phase, it created a bearish FVG. You can see that candle 1, candle 2, you see the long candle 2, and then candle 3. Now in this case, we mark out our origin. You see that's our origin. You can decide to mark it out, you can decide not to, but I just decided to mark it out, but let me just ignore that. So our major target is to mark the closing of candle 1, mark it. That's it. We got our line there, candle 1, and then the opening of this. All right, so we see this and this. Okay, I didn't mark it very well. Take note, your mark, how you mark is very important. You must make sure you mark very well, because a wrong marking can give you a wrong entry. So we mark, so you see our gap, very clear gap. There was no trading activity within this gap. And then using our Fibonacci retracement tool, we mark it from this point down to this point. All right, so it gives us our 50% level, and then all we need to do is to wait patiently for price to retrace back into this 50% level. But you see, in this case now, in this example, we didn't see price. You know, I told you when I was teaching, I said in some cases you may even see price retrace down to this point. You see that now, down to this point. But in this case, we didn't see price retrace even to the 50% level, but we saw price just retrace. Where is my horizontal line? Let me mark that 50% level. You see that? We see price retrace into the fair value gap, and then created a change of character and began to dump to the downside. You see that? So if you are following strictly the 50% rule, you are going to miss this trade. You see that? But this is a clear example of what we're talking about. This is an FVG. Price moved into the FVG. Now, the 50% I gave is not cast in stone. It's just what I use. You can refine to whatever strategy works for you. So price moved in, but did not come to our 50% level, where maybe we would have set our limits. You see that? We put our stop loss maybe at the top of this candle 1, and then we target the highest point here, the high here. You see that? But price did not come to trigger this. You see, but somebody that would have caught this here immediately after seeing the change of character would have still made profit. But you see, as a trader, you must have rules that are confirmation rules that you follow. And when those confirmation rules when the market does not meet your requirement, don't apologize for not entering the trade. You see that now? So I personally, I wait for price to come within 50% of my Fibonacci retracement tool before I take the trade. So this is an example of another example of an FVG, even though it did not meet our requirement. So you can look at the chart, you can look at XAUUSD, you can look at GBP/JPY, you can look at EUR/USD, you can look at any of the charts, even your volatility pairs, indices, and then test run this principle and let me get your feedback. Thank you guys. Have a wonderful day.